Ever wondered what a hedge fund is and who can receive it? Well, let's dive right in. A hedge fund is a type of investment vehicle, but it's not your everyday run-of-the-mill investment. It's a private pool of capital actively managed by professional managers who aim to produce high returns regardless of market conditions. Hedge funds use a variety of investment strategies and instruments. They can invest in anything from stocks and bonds to commodities, real estate, and even art. The key here is the flexibility in investment choices, which is a stark contrast to traditional investment methods. So, who can invest in a hedge fund? Generally, it's high net worth individuals and institutional investors such as pension funds and endowments. The exclusivity comes from the fact that hedge funds often require significant initial investment, often upwards of $1 million. So, hedge funds are exclusive private investment vehicles. But what makes them so special? Let's delve deeper into it in the next scene. Now let's delve into the advantages of hedge funds. First and foremost, hedge funds are often associated with the potential for high returns. This is because these funds are not limited by the same regulatory constraints that traditional mutual funds are. They can trade in a wide variety of financial instruments such as derivatives and short-sell stocks, which can lead to substantial profits. Yes, the risk is higher, but so is the potential reward. It's akin to the old adage, no risk, no reward. Another advantage of hedge funds is their flexibility. Unlike other types of investment vehicles, hedge funds have the ability to pivot their investment strategy quickly in response to market conditions. This means they can capitalize on opportunities as they arise and mitigate losses during downturns. Imagine it as a nimble sailor, adeptly navigating the unpredictable seas of the financial market. Moreover, hedge funds are managed by professionals who are experts in their field. These fund managers have a deep understanding of the financial markets and use sophisticated strategies to generate returns. They are the captains of the ship, using their knowledge and experience to steer the fund through the market's choppy waters. Their expertise often inspires confidence in investors, adding another layer of appeal to hedge funds. On top of that, hedge funds also provide a layer of diversification for investors. By investing in a hedge fund, one's portfolio isn't solely tied to the performance of traditional equities or bonds. This can help spread risk and potentially enhance returns. Think of it as not putting all your eggs in one basket. Lastly, the performance of hedge funds isn't directly tied to the broader market. This means they can potentially provide a positive return even when the stock market is performing poorly. It's like having an umbrella during a storm, providing some protection against the downpour. So, the potential for high returns, flexibility, and professional management are some of the appealing aspects of hedge funds. But what about the other side of the coin? Just like any other investment vehicle, hedge funds have their drawbacks. It's crucial to understand these before making an investment decision. Let's start with the high fees. Hedge fund managers typically charge a management fee and a performance fee. The management fee is usually about 2% of the fund's assets, while the performance fee can be as high as 20% of the fund's profits. This means that even if the fund doesn't perform well, the managers still get their cut, which can eat into your returns. Then we have the risk factor. Hedge funds are known for their aggressive investment strategies. They often employ leverage, short selling, and derivatives, which can enhance returns but also amplify losses. While hedge fund managers are experts at risk management, the possibility of substantial losses is a reality that investors must grapple with. Next up is the lack of transparency. Unlike mutual funds or ETFs, hedge funds are not required to disclose their holdings to the public. This can make it difficult for investors to assess the fund's strategy and risk profile. And while many hedge fund managers are reputable and trustworthy, the opacity of these funds can sometimes hide fraudulent activities. Finally, let's talk about lock-in periods. Many hedge funds require investors to commit their money for a certain period, usually at least 1 year. This lock-in period can limit your liquidity, making it difficult to access your money in case of an emergency, or if you want to change your investment strategy. In sum, while hedge funds offer the potential for high returns, they also come with significant drawbacks. The high fees can diminish your profits, the aggressive strategies can increase your risk, the lack of transparency can hinder your ability to make informed decisions, and the lock-in periods can limit your liquidity. So before you dive into the world of hedge funds, make sure you understand these cons and weigh them against the potential benefits. Hence, the high fees, risk, lack of transparency, and lock-in periods are some factors that might deter some investors. One might wonder, who can invest in these funds? not all who wish to dive into the ocean of hedge funds can do so. It's a world that's exclusive and selective, primarily due to the level of risk involved and the significant amount of capital required. The primary gatekeepers of this exclusive club are accredited investors. Now you might be wondering, what exactly is an accredited investor? In simple terms, it's an individual or a business entity that is allowed to deal in securities that may not be registered with financial authorities. They are considered insiders and are recognized based on their net worth, asset size, governance status, or professional experience. In the United States, for example, an accredited investor is defined by the Securities and Exchange Commission as someone who has a net worth of more than $1 million, excluding the value of their primary residence, or an income of over $200,000 each year for the last 2 years, or $300,000 combined income if married. Why such exclusivity, you might ask? Well, the reasoning behind this is that such individuals or entities are considered to have sufficient financial savvy. They are deemed capable of understanding and taking on the potential risks associated with these unregistered securities. Hedge funds, being high-risk, high-reward investments, require a certain degree of financial acumen to navigate. They aren't your typical mutual funds. They involve complex strategies like leveraging, derivatives, and short selling, which can be challenging to comprehend and manage for the average investor. Moreover, the high minimum investment requirements, often in the millions of dollars, act as another barrier. These funds are designed for those who can afford to take a hit without it significantly impacting their overall financial health. So it's clear that hedge funds are not for everyone. They are designed for accredited investors who can take on more risk for the chance of higher returns. The big question is, are hedge funds the right choice for you? As we delve into this question, it's essential to bear in mind that investing in hedge funds isn't a one-size-fits-all solution. There's a range of factors to consider, and these will be unique to your own financial situation, goals, and risk tolerance. Let's start with risk tolerance. Hedge funds are typically more volatile than traditional investments, which means they can offer higher returns, but they also come with higher risks. If you're someone who prefers a steady, predictable growth or cannot afford to lose your investment, then hedge funds might not be the best fit for you. On the other hand, if you're comfortable riding the waves of the market and can afford to take a loss, then you might want to consider hedge funds. Next, let's talk about your investment goals. Are you looking for a quick return, or are you more interested in long-term growth? Hedge funds can be an excellent choice for those seeking high returns in a shorter time frame. However, if you're saving for retirement or another long-term goal, you might be better off with a more traditional investment strategy. Lastly, your financial situation will play a significant role in determining if hedge funds are right for you. Remember that hedge funds often require a substantial initial investment, and it's not uncommon for these to be in the millions. So unless you're a high net worth individual or an institutional investor, hedge funds might not be the most accessible or suitable investment option. In conclusion, hedge funds can provide a unique investment opportunity with the potential for high returns. However, they also come with increased risk and a high barrier to entry. It's important to carefully consider your own risk tolerance, investment goals, and financial situation before deciding to invest in hedge funds. So, as with any investment, it's crucial to do your research and understand the risks before diving in. Let's quickly recap what we've learned about hedge funds. These investment vehicles, favored by the wealthy and institutional investors, come with an array of benefits. They offer a potential for high returns and risk diversification, not to mention the chance to capitalize on the expertise of seasoned fund managers. However, we've also shed light on the drawbacks. Hedge funds are not without their risks, including potential for significant losses and limited liquidity. They're also notorious for their hefty fees and lack of transparency. We've also clarified that hedge funds are a playground primarily for accredited investors. That means you need a certain net worth or income level to participate. And lastly, we've emphasized the importance of introspection before diving in. Consider your financial goals, risk tolerance, and investment horizon. Remember, knowledge is power. Make sure you're armed with all the facts before making any investment decisions.